We're still trying to predict what's going to happen. I tracked down Axel Merk. He's the president of CIO of Merk Investments. He gave me his take and his thoughts on Janet Yellen's performance in her first press conference as new Fed chair.
The key difference between Janet Yellen and Ben Bernanke is that she doesn't have this deeply rooted academic framework. Bernanke always talked about being a student of the Great Depression. She is much more ad hoc, and so she doesn't really know herself yet what she wants to do, I think, because she focuses so much on unemployment, then she tells us to ignore the unemployment target. The one thing that we're reasonably certain about is that, in her view, inflation is not a problem, and that all but certain we will be late in raising rates once inflation has picked up already, which means that it's going to be a long way off before the Fed is going to play tough, if ever.
You say late. Explain to us what you mean by being late.
Well, inflation is not something that shows up and then you deal with it. You've got to be ahead of inflation. Once inflationary expectations are ingrained in people, people expect wages to go up. They'll ask, the wage demands are going to go up. It's far more difficult to fight it later on. In the meantime, Janet Yellen is the first Fed chair that says our dual mandate to pursue maximum employment and keep inflation steady is not a conflict because inflation is not a problem. I could not disagree more, but she is calling the shots, not I am, and so that's what we have to assume. And if you take it from another perspective, I don't think the U.S. can afford high rates. We are financing U.S. government debt at less than 2% right now, the average debt in the U.S. If rates really were to go up, if inflation were to be a problem, we couldn't afford it. And so we have this bias in the system that rates are going to be low. They might tick up a little bit, but we are not going to have a tough Fed under Janet Yellen's leadership.
Let me ask you this. For our viewers that are watching around the world, they're not just looking at their U.S. portfolios, but they're probably looking at their portfolios from various countries. If the Fed left rates basically where they are at now, what's wrong with that? Why should those folks care around the world, and how would it impact them?
The key difference between U.S. and emerging markets in particular is that in the U.S. we have far greater liquidity. So when there's uncertainty, we have markets that move up and down and whatnot. But in weaker emerging markets in particular, that lack of liquidity is poison. When the only thing you can invest in some of the weaker emerging markets are treasury securities, well, the flight is out of these markets and everybody runs through a very small exit. If you have a more advanced economy, including China, money gets stickier. You can invest in real projects. And when uncertainty emanates, then this money doesn't flee right away. And so what we need is a steady course. And if we have a steady course from the Fed, and it's very tough because the Fed is walking a tightrope, then things are going to be fine. But if you think that we have some tough decisions ahead of us, it's going to be very tough for the weaker emerging markets in particular.
Before Janet Yellen was in place, there was this discussion that if the unemployment rate dipped below a certain level, that the Fed would be more open to perhaps raising interest rates. That tune has changed very slightly. Where do we go from here? What will the Fed really be focused on? Or I should say, maybe perhaps what should investors be focused on?
Well, the Fed is very transparent. The Fed is transparently confused. Historically, the Federal Reserve can look at market indicators, long-term bond prices, short-term bond prices, to see how healthy the economy is. They can't do that because they're manipulating these prices. So the Federal Reserve is reading tea leaves just like all of us, which means they are interpreting last month's unemployment report, and they don't really know what they want to do.
I'm going to give you a lot of power right now. If you were in charge of the Fed, you're criticizing the current policy, what should the Fed be doing right now?
Well, the Fed needs to allow market forces to play out. That means the Fed needs to get out of the way. And it's extremely difficult because of the corner they have painted themselves into. So it's very easy for me to criticize them, but they need to extricate themselves out of the mess they're in. And the way they do it is with gradual steps. And sure, the quote-unquote tapering is a first step, but tapering is no exit. They continue to print money. And what they need to do is they need to say that the government has to spend less money. They're giving a free pass to the U.S. government to continue to spend too much money, and they have to put their foot down. And that is extremely painful, and they're not willing to take that political risk that comes with that.
Axel Merk, President and CIO of Merk Investments.